MELI stock was down 16% yesterday after reporting what I thought were very strong earnings results. The business seems to be growing strong, but the market clearly wasn't very happy. So as a shareholder of MELI, I want to discuss its earnings results and why I have bought more of this business. I also created a 10-page stock analysis report on MELI, which you can download for free via the link at the top of my description. But with that being said, let's hop right into the video. As always, I went through MELI's most recent earnings report and I took some screenshots of all of the highlights that I think investors need to know. And this is the first screenshot right here where it says, net revenues and financial income of $5.3 billion, up 35% year over year and 103% on an FX neutral basis. Income from operations was $557 million with a 10.5% margin. Net income was $397 million with a 7.5% margin. $50.7 billion in total payment volume, up 34% year over year and 73% on an FX neutral basis. And finally, $12.9 billion in gross merchandise volume, up 14% year over year and 71% on an FX neutral basis. So MELI had a very strong earnings report, and even after the FX changes and headwinds that they have been experiencing, their revenue still grew by 35% on a US dollar basis, which is very strong growth for a business at this scale. Then they continue on with their letter to shareholders where it says, "We believe we are making excellent progress on our long-term strategic goals of increasing the penetration of online commerce in Latin America, becoming the principal financial services provider to users of Mercado Pago, and scaling our acquiring business. Our competitive position is strengthening as retention improves across our businesses. This gives us great confidence as we invest to fully capitalize on the many growth opportunities that are ahead of us, knowing that our ecosystem is uniquely placed to capture those opportunities." So right away, MELI is saying that they are investing in the future growth of the business and their market share down in Latin America is clearly growing. Then they talk about commerce where they say, "E-commerce penetration lags the USA by almost a decade. We see a huge runway for future growth. Market share grew in all major geographies. Unique buyers across the region reached 61 million, rising 21% year over year. This is the second quarter in succession that unique buyer growth has accelerated to new post-pandemic highs." So as we can see, they are clearly taking more market share in the e-commerce space down in Latin America with 21% year over year growth to unique buyers. This all right here sounds great to me as a long-term shareholder who wants the business to be as successful as possible a decade, 2 decades, and 3 decades out into the future. Continuing on through the shareholder letter, this says, "This is the reason why we continue investing in expanding our logistics infrastructure to increase the penetration of fulfillment in Brazil and to keep up with the strong pace of growth in our commerce operation in Mexico. As such, we opened 5 fulfillment centers in Brazil in the third quarter of 2024, plus 1 in Mexico. Although new facilities can create short-term margin pressure, they are critical to our long-term growth, scale, and cost dilution." So the story of this quarter for MELI was the business saw incredible top-line growth and their business growth is actually accelerating. However, their margins took a pretty big hit and their margins compressed on a year-over-year basis because the company is investing in so much future growth. And as they clearly said right here, as they're building out multiple logistics, networks, and buildings, that is going to cause a short-term hit or pressure on their profit margins. But again, as a long-term shareholder, I don't really care about profits in this quarter. What I care about is the business building intrinsic value? And I do believe that they are. Like for example, I believe MELI's intrinsic value on this quarter went up in a pretty significant way, but their profits this quarter went down. And we are going to discuss intrinsic value versus profits near the end of the video by referencing some of Berkshire Hathaway's or Warren Buffett's letter to shareholders and how he thinks about this. But continuing on, at the bottom of the screenshot it says, "Advertising is a strong profit driver for Mercado Libre, with significant potential for growth as the digital retail media trends gathers steam and first-party data becomes increasingly important. Advertising revenue grew 37% year over year in the third quarter." So for those of you who may not know, MELI does have a strong advertising business, which is basically identical to Amazon's advertising business, and this business is growing very strong as well. So moving on to the next screenshot, this one talks about MELI's Fintech services, where they say, "Monthly active users rose 35% year over year to 56 million in the third quarter. Engagement is rising, with power users, those transacting in 9 out of the last 12 weeks, growing at a much faster rate, and transactions and products per monthly active user also rising. The credit card had another good quarter in the third quarter, with the portfolio of $2.3 billion growing strongly by 172% year over year and 28% quarter over quarter. The total credit portfolio grew at its fastest pace since the first quarter of 2022, rising 77% year over year to $6 billion. The consumer book grew 37% year over year. Then at the bottom it says, finally, we accelerated our origination across products in the quarter, and given that we provision our expected losses up front, this resulted in higher bad debt in this quarter. Now this right here was also the reason why MELI's net income and net margin dropped this quarter, is because they are growing their credit portfolio so freaking quickly. And how lending businesses work is when they grow their credit portfolio, they have to set aside cash today for future expected losses. And that cash set aside goes against net income. So since MELI is growing its credit portfolio so quickly, it is having to set aside a lot of cash today for future potential loan losses. And that is why the margin took such a massive hit. But there's really no other option for MELI unless they want to slow down growth. So the company's two options are invest in the future growth of the business and really pursue strong growth at a cost to short-term margins or short-term profitability, or slow down the growth of the business just to boost profits this quarter. Now, as a long-term shareholder and someone who wants this business to be investing in the growth, a decade from now, I am completely fine with them lowering margins this quarter and in the short term to boost profits in the future. I think that's a very fair thing for this business to do for long-term shareholders, but it's just that Wall Street doesn't think this way. Wall Street tends to be very short-term focused. Analysts tend to be very short-term focused, and they want them to produce as much profits as possible every single quarter. But MELI is very clearly saying, let's sacrifice profits this quarter for much more profits and growth in the future. And again, as a shareholder, you got my vote of approval. That's kind of why I bought more shares, is because I think there's a disconnect between intrinsic value and future business value and what Wall Street was expecting this quarter. So let's continue on. And this says, assets under management had another outstanding quarter, growing 93% year over year to $8 billion. We have seen this work fantastically well in Argentina in recent years, and more recently in Mexico, where funds invested in our remunerated account increased 345% year over year. Intrinsic is scaling well, revenues growing 36% year over year. So MELI's financials business is just exploding. Like these growth rates are ridiculous. Then they talk about their acquiring businesses, where they say acquiring total payment volume grew 30% year over year in Brazil on an FX neutral basis, with the point of sale business accelerating. Acquiring total payment volume growth was solid in Mexico at 46% year over year on an FX neutral basis, with in-store payments growing at more than 100% year over year. We have a huge opportunity in Mexico to lead the transition to digital payments. So for those of you who may not know, Mexico does not have a large penetration of digital payments, and Mercado Libre is one of the companies that wants to bring digital payments to Latin America and really in Mexico. And right here again, they say that their in-store payments grew 100% or doubled year over year. So MELI is seeing fantastic growth in every single one of their businesses. Like there's not one thing here that I think is bearish for the company. Then MELI talks about their margin compression in the quarter, where they say, most of the 7.4% margin compression is due to the strategic investment decisions that we made in the quarter, which included the investment in our credit business, which increases our upfront provisions and generates the largest single contributor of a 3.4% hit in the year-over-year margin decline. And then the second reason was their investment in shipping. As we saw, they opened, I believe it was 4 new fulfillment centers in the quarter. So they are investing in future growth, and that is why profit margins are down. This next screenshot shows us the year-over-year US dollar growth rates by quarter. So for total MELI, they saw 35% year-over-year revenue growth versus 43% year-over-year revenue growth in the third quarter of 2023. The gross merchandise volume also grew by 14% versus 32% last year, and the total payment volume grew by 21% versus 38% last year. This business's growth on a year-over-year basis is slowing down. However, it does have certain aspects of the business that are actually starting to re-accelerate. Now, moving on to the next screenshot, this is the year-over-year FX neutral growth rates. So this is basically if the currencies were all valued the same as they were last year, then this is how the business would have actually grown. So we can see that total MELI would have seen 103% year-over-year growth rates to revenue, which is just insane. It's also worth noting that in the third quarter of 2023, they grew at 75%, So growth would have actually accelerated on a year-over-year basis if FX headwinds were not hitting MELI so hard. We can also see that gross merchandise volume would have accelerated to 71% year over year. Total payment volume would have also accelerated slightly, and total payment volume acquiring would have seen a slight deceleration. So on an FX neutral basis, this business is actually seeing accelerated growth, which I think is extremely bullish. Now let's move on to the fintech service highlights. So right here we have the net interest margin after losses. Last year in the third quarter of 2023, it was 37.4%. And this year it fell by 13% down to 24.2%. However, the net interest margin after losses is calculated by taking the credit revenues minus provisions for doubtful accounts and funding costs. So it's quite literally calculated by including the provisions for future credit losses that MELI clearly said was much higher this quarter on a year-over-year basis. Now, if we take a look at the past dues or the overall performance of the credit portfolio, we can actually see that it is down on a year-over-year basis from 20.3% to about 18%. So MELI's loan book quality is actually improving at the same time as their GAAP or reported net interest margin is declining. And this is kind of where the disconnect from the market, analysts, and investors is really coming from. Then we can also see their provisions coverage is still sitting at 150%, which is very good. All right, now this next screenshot comes from the transcript of the third quarter earnings results for MELI, and this is the co-founder and CEO, where they say, "Hello everyone, I am pleased to share that Mercado Libre had another quarter of outstanding growth. We had an excellent quarter across all of our businesses and geographies, so the strong performance was really all around. With these results, we reinforced our position as the leading e-commerce and fintech platform in Latin America. Every time we have invested in enhancing our customer experience, in the past, we have been rewarded with strong growth and improvements in our market position. In this quarter, we continued to make strategic investments in our platform, both commerce and fintech, and have resulted in gross merchandise volume growth of 34% on a year-over-year basis in Brazil and 27% in Mexico. This also results in market share gains in both countries. In Argentina, items sold grew at 16%, and we surpassed the 60 million items sold in our platform, which is the highest ever volume. We continue to see improvements in the Argentinian market. We have also added a record of almost 7 million new buyers in our platform. This is a number higher than the number that we saw during the peak of the pandemic. So let me be clear on that. Not even during the explosion of demand that we experienced during the pandemic, we saw a number of new users at this level. Then an analyst also asked, I wanted to ask about slide 19. It's the margin bridge and specifically about the bad debt call out here. I'm wondering, is that like the fail first of new originations, or is there something underlying the credit quality that's maybe different than you had modeled? Then the CEO says, let me start with the last part of your question. In fact, we are very confident about the credit quality and the prediction of our models. And this is the reason, as Osvaldo explained, that we're accelerating our credit origination. So that part is not explaining this 3.4 percentage point compression that you are pointing out to. Here, what's happening is that we increased roughly $1 billion our portfolio quarter on quarter. If you were to look at it on a year-over-year basis, we increased by 72%. When you increase the portfolio very rapidly, as we did this quarter, you provision the losses up front. And that happens not only on credit card, but also on consumer credit and merchant credits, which were very profitable books. But as we accelerate, we need to provision up front, and that generates an incremental bad debt, which is generating compression margin this quarter. So it's not related to the performance of the portfolio. So there you have it directly from the CEO. As I said earlier, the margin compression that MELI saw this quarter was because they are setting aside money today for future potential losses in their credit portfolio, which I think is very fair. All right, now this next screenshot comes from my massive doc that I am building, which takes all of the highlights from all of Berkshire's historical letter to shareholders. For those of you who may not know, I am creating a massive doc for my Patreon members of all of the highlights and key lessons that I am finding through literally all of Berkshire Hathaway's historical shareholder letters all the way back to 1977. This document is currently a work in progress, but I am going to be sharing it with my Patreon members, and then also making Patreon-only videos going through this entire document on all of the lessons that Warren Buffett shares. So if you are interested in getting access to this document and all of the content that I am going to be making around it, then consider joining my Patreon, as it is only $10 a month, and you will also get access to my portfolio, all of my buys and sells, my Discord community, literally dozens and dozens of Patreon-only content, and so much more. Again, it's only $10 a month, and there is an extreme amount of value over there. And my Patreon members have been absolutely loving it. The feedback over there has been incredible. So seriously, if you are an investor or you're someone who wants to learn more about investing, then consider joining my Patreon. But with that quick plug out of the way, this is what Warren Buffett has to say in relation to what MELI is currently doing today. So this says Geico's performance, spending money on marketing, and how Buffett thinks about expenses. In 1999, we will again increase our marketing budget, spending at least $190 million. In fact, there is no limit to what Berkshire is willing to invest in Geico's new business activity, as long as we can concurrently build the infrastructure the company needs to properly serve its policyholders. Because of the first-year costs, companies that are concerned about quarterly or annual earnings would shy from similar investments, no matter how intelligent these might be in terms of building long-term value. Our calculus is different. We simply measure whether or not we are creating more than $1 of value per dollar spent. And if that calculation is favorable, the more dollars we spend, the happier I am. Then in a future letter to shareholders, I found this. Don't pay too much attention to year-over-year figures. Intrinsic value growth is what counts. Yearly figures, it should be noted, are neither to be ignored nor viewed as all important. The pace of the Earth's movement around the sun is not synchronized with the time required for either investment ideas or operating decisions to bear fruit. At Geico, for example, we enthusiastically spent $900 million last year on advertising to obtain policyholders who deliver us no immediate profits. If we could spend twice that amount productively, we would happily do so, though our short-term results would further be penalized. Many large investments at our railroad and utility operations are also made with an eye to profits well down the road. So here what Buffett is saying is typically that a lot of businesses and Wall Street will hold off making investments today if it lowers their margins or their net income today, because they're so focused on just boosting the net income or earnings this quarter or this year. However, as Buffett is very clearly saying, he is very happy to spend a large amount of money today at the expense of profits today if it will increase profits in the future. And this is exactly what MELI is doing right now. And you can clearly see that the market doesn't like that MELI is doing this, but as a long-term shareholder, I actually do like it. And this is why I have increased my position in MELI overall. I think that there is a disconnect with what the market wants the business to do today and what is actually building long-term wealth for shareholders. So I think that MELI is doing the right thing for long-term shareholders. We can actually see that the stock is back up 4.4% today, essentially. And I think that this is just a fantastic business. And when I think about the long-term profit potential of this business, I think it is absolutely massive. And how I think about MELI's valuation today is this is a $90 billion company on the stock market. But I think that this business has the potential to produce tens of billions of dollars in profits over the next decade. So even on a valuation basis, I do actually think that MELI is looking attractive today. And this is also a business that is just continuing to grow its revenues at 35% consistently. And I don't think that's going to stop anytime soon. So for all of those reasons, I have decided to increase my MELI position, and it is making up a larger portion of my portfolio now at around 3%. And if you want to track my portfolio again, then consider joining my Patreon. And if you also want to get the 10-page research report on MELI, then click the link at the top of my description because you can download it for free. But that is going to wrap up the video for today, everyone. And if you did enjoy this video, then please remember to leave a like on it. And if you want to stick around and see more content like this, then please consider subscribing to my channel as well. But with all that being said, that is going to wrap up the video for today, everyone. So thank you all again so much for tuning in. As always, I truly do appreciate it, and I really hope to see you all again in my next video.